Hey guys, in this video we will try to understand the concept of time value of money. We will start off with the basic question that everybody usually starts with. Would you choose $100 today or would you choose $100 a year from now? Now, as we all know that money received today is much more valuable than money received or promised in the future. One main reason for that is inflation, but we will try to go deeper and understand why, even if no inflation existed, you would still likely choose $100 today instead of $100 in a year. We will also try to understand concepts like opportunity cost, risk premiums that are attached to any principal amount that you invest or you're looking to invest. And we will also see the two fundamental choices that anybody who has some money lying around always has. Okay, so coming back to the question of $100 today or $100 a year from now, most people would instinctively pick $100 today, and that instinct is one of the core topics of finance. The interesting part, however, is not what you choose, but why you chose it. At first, you might think it's inflation, as we all do. As we know that money loses its value with time. So $100 today can buy you a lot more than $100 in a year from now. But even if we remove inflation from the picture, we would still choose $100 today. The main reason why that is the concept called optionality. Money today gives you the ability to act. You can spend it or invest it, or you can just even hold it if you wish. But the main point is that it gives you agency over that money. You have ownership over that money, and you can choose to decide whatever you want to do with that money. Whereas money that you are going to receive in the future is always going to be promised money. Even money that is supposedly guaranteed to you is also promised money. Okay, so just to paint a picture, the United States is considered a risk free economy, but you need to understand that there is no objective reality or a scientific fact that gives the US that status, where there is no reality, there is no scenario where US can default on their debt. US is said to be a risk-free economy because of its sheer stature. How strong the country is or how strong its economy is considered to be. That everybody believes that there is no situation where United States can default on their debt. So it is considered to be risk-free. The main word here is considered. But any and all money that you invest, even in an economy like USA, is going to be promised money, right? The return that you get of that investment, it is always going to be promised. Even if they say guaranteed, there's always going to be an iota of risk that you take when you give away money from your wallet in hope that someday you're going to earn money on top of it. That is why there's always an optionality attached to your money, that I would rather have money today than money tomorrow, because I may never just receive that money in the future, the money that I have been promised. So basically, you are locked into waiting, and waiting has a cost. In finance, that is known as opportunity cost. If you choose to receive money later, you are giving up what that money could have earned for you in the meantime. That foregone return is not visible, but it is very real, it is tangible, it is calculable. That is why interest rate can be viewed as an opportunity cost, because that is the value that you sacrifice by not using your money today. And this leads us to the core idea, the time value of money. Money is not just about how much you have, but when you have it. That is the main aspect. Okay, so time value of money is basically just an equalizing factor that we use to compare cash flows at two different time periods. And the instrument that it uses to equalize those cash flows is the interest rate. And there's two sides to this coin. There's two ways to compare your money. So this is situation A, and here we are just trying to understand if we invest $100 today, how much that money is going to be in 3 years time period. Now this is what we call compounding, where we are looking ahead into the future and we are trying to estimate what the future value of our money is going to be. In this example, say we are trying to compound our money by 10% annually. We would want to estimate what is the value of that $100 going to be in 3 years' time when we compound it by 10% annually. So we will use the formula to calculate that. In this formula, we are basically multiplying our principal amount by the compounding factor, which we calculate using the interest rate R, or also compound rate, and we divide it by n, which is the number of times interest compounds per year. In our example, it is going to be 1 because our interest is only compounded once in every year. So the number of times is going to be 1, whereas if, let's say, interest was being compounded monthly, it would have been 12. So it would be 0.10 divided by 12. But in this case, it is going to be 0.10 divided by 1. And we are also going to multiply n by t. So number of times interest compounds per year into time in years. So to calculate it, it is going to be $100, which is our principal amount, and we add 0.10, and n is going to be 1 in this case, and we are going to multiply n by t. So 1 into 3. So in here our compounding factor is going to be 1.10, and we are going to do it 3 times. So the end result is going to be somewhere around $133 approximately. So this is going to be our future value. This is going to be the future value of $100 after 3 years time if we compound it at 10% annually. Okay, so the next situation is you basically want to have $500 after 3 years, and you want to understand how much you should invest today so that that money grows to at least $500 after 3 years, so that basically you can get that $500. But there's a second part to this question as well, which is at what rate should you invest your money now so that it can grow to that $500 level after 3 years? And this is what we call the discount rate, because we know that we want to have $500 in 3 years, but we are looking backwards from the future and trying to ascertain what is the value going to be, what is the value of our investment amount going to be, and at what rate that investment needs to grow in 3 years so that it can get to that 500 level. Now, this rate is subjective. There's no one size fits all, but most people, or in most situations, we use the risk free rate of an economy to basically discount our investment. But in a more real life scenario, let's say you are wanting to be more aggressive with your investment, or you are, let's say, looking to fund your education, and you don't want to just use the risk free rate because you want your money to grow more than that, because just growing at a risk free rate isn't going to cut it for you or for your purpose. So let's say you invest in a large cap fund. So the interest or the money or the return that you earn on that mutual fund, let's say, or that ETF, is going to be greater than the risk free rate, because equities will carry their own risk premium, and that risk premium will compensate you by giving you more returns, or ideally it should at least. So you might use that instead of a risk free rate. But the premise is that greater the discounting rate, less would be your present value, because if your money is, let's say, the risk free rate in an economy, risk free rate is 3%, but because you are trying to invest in a large cap fund, that large cap fund in the last 3 years has given you on average 12%. So you are taking this as an estimate of what it is going to give you in the next 3 years. So this 12% is much larger than 3%. So when you discount the $500 using this 12%, your present value is going to be much less compared to if you discount this same money by 3%. So the main rule is that larger the discount rate, less would be your present value. So formula wise, the main idea is, let's say we try to discount $500 using that 12% return from a large cap equity fund. So the formula would be 500 divided by 1 plus 0.12, and our time period in this case is 3. So the discounting factor, which is the denominator, is going to be somewhere around 1.4. I have rounded off, but the decimal places are going to be more than this. The main idea, as some of you can already see, is bigger the denominator, smaller would be the answer automatically, that is basic mathematics. Bigger the denominator, smaller would be the value. So as our discounting factor starts to rise, our present value will automatically start to go down. And our discounting factor can only rise when our return, the discounting rate, is going to increase. And logically, from a pure investment perspective, if the return that you are earning on your investment is larger, meaning you are more aggressive on your investment, you do not need to invest more money to earn your target money, because your money is anyways growing at a much larger pace compared to, let's say, a risk-free rate. Okay, so up until now, we have understood how we can estimate the performance of our investment, whether we are trying to look ahead into the future and estimate our future value of investment, or whether we know how much money we want to have after X amount of years and we are looking back from it. But a natural question arises: how would you judge that performance? How would you know whether the estimate of your investment performance is good enough for you and it is worth it for you to put your money in that investment? This is going to be the next part of our discussion, where we will understand how we judge that estimate, if it's good enough for us. And before that exact answer, we will understand the three choices that every investor faces if they have some money lying around. For this argument, we will assume that the person we are talking about, let's say an imaginary person, has some disposable income, because if you don't have any disposable income, you don't get to choose how you spend your money. You basically have to spend all of your money on the needs, on your living expenses to survive. It is only when you have some disposable income when you get to choose whether you want to do choice A, choose choice A, or choose choice B, action A or action B with your money. Okay, so the first choice that every investor has, a pretty simple choice actually, is to do nothing with your money. Just keep it as is. It's lying in your wallet and you don't want to do anything with it, or you are at least not actively thinking about doing anything with your money, so it's just there. The second option is consuming that money. So you can go out and spend your money on any goods or services and gain pleasure out of it. Remember that here we are talking about disposable income, so we are assuming that all of our needs are already met. We don't have to spend this money on our living expenses or anything that is crucial to our survival. The disposable income is already above our necessary level of income we need to survive. So, obviously, when we go out and spend this money on any goods or services, we are going to get some pleasure out of it. So it is going to be a discretionary spend in that sense, separate from your needs. The third option, and the most crucial one, is investing this money. And this is the center point of our whole discussion. In the presence of an attractive investment option, we can go ahead and invest this money. And what is that attractive option going to look like? What is the meaning of the term attractive? We will try and understand. Now, leaving investment aside for a moment, if I compare consumption with idle money, which one do you think is better? It is much better to consume your money rather than keeping it idle, because as time goes on, let's say we are sitting at time equals to zero, and time passes by and it's already 1 year, and the inflation for that year was 10%, just for the sake of the argument, and you had $100 and you chose to do nothing with it. It's just sitting there. After a year, your money is already at a $90. Even when you did nothing with it, you didn't spend it or didn't invest it, it's there. But the intrinsic value of that money is reduced by inflation. So it is much better to consume your money now rather than keeping it idle if you're not looking to invest that money, because inflation will play a part on your will act upon your money irrespective of what you choose to do with it. Now, this choice whether to sit on idle money or to consume your money is only available when there's no attractive investment opportunity available to us. We are going to now dig deeper into what do we mean by an attractive opportunity and the choice that it is going to provide us. Okay, the purpose of any investment is not just to maximize your return, because if that were the case, you would always choose the most riskiest investments. The purpose is to maximize your risk adjusted returns. For a given level of risk, is your investment giving you the maximum return compared to the alternates that are available to you? And this is where the concept of required rate of return comes into picture. This return basically tells us what are my risk premiums over and above the risk-free rate if I am taking on extra risk. So to calculate it, we have the risk-free rate of an economy, and plus we add on our risk premiums. And through this return, we ascertain whether an investment opportunity is attractive enough or not by looking at the performance, and if the performance is greater than or equal to R, which in this case is the required rate of return, only then is the investment opportunity attractive enough. Otherwise, it makes no sense for you to put money in that investment, because based on the amount of risk that you are taking on, you're not earning enough on that investment. Now, there are multiple ways to judge risk adjusted return, but a more thoroughly used or a more widely used tool is a Sharpe ratio, which tells you for one extra unit of risk how much return can you gain on an investment. But we're not going to go deeper into it. Okay, so in calculating the required return, how do we estimate our risk premiums? And what are those risk premiums in fact? So we add these risk premiums over and above the risk free rate, as we have already seen, but we start off with the inflation premium, which basically compensates our investors for expected inflation, and it basically reflects the average inflation over the life of the investment. So if you are, let's say, buying a bond, you would estimate the average inflation you expect to be over the course of that maturity of debt, and add that premium to your return to compensate you for that inflation, because as we have already seen, money loses its value with time. So to compensate you for that loss of value, you need that inflation premium. Just a side note, the risk-free rate plus the inflation premium is also known as the nominal risk-free interest rate, or the nominal rate that we hear economists talk about, or just any news channel talk about. So next time you hear it, you should be able to now understand the difference between real interest rate, nominal interest rate. Real interest rate is basically excluding inflation, but when you add inflation to our interest rate, it becomes nominal interest rate. We also have the default risk premium, and it is also the most widely heard risk premium. And it basically compensates investors for the possibility that the borrower will fail to make a promised payment in the contracted amount and in the contracted time. It rolls back to the example we saw earlier of the US economy, even after being considered a risk free economy, can still default on their debt. So they will also carry some default risk with them. So, another side note, when we say that an economy is risk free, we don't mean that the default risk of that economy is exactly zero. We mean that it is almost zero. It is practically lowest. It is the lowest that you can practically have for an economy. That is what we mean when we say that an economy is risk free. We also have liquidity premium, and it basically compensates investor for the loss of value relative to an investment's fair value when you are closing down that position. So, if let's say you are trading in an investment tool which is not very liquid, so as you are selling your position, you can manipulate the price while closing that position, because the liquidity is not there. To protect yourself against that loss of market value, borrowers compensate you by adding that liquidity premium to your return. Just to give you some context, UST bills don't carry any liquidity premium because the quantities that they are traded in are so large that no single investor can manipulate the market or affect the market price while trading that instrument. So T bills carry no risk of liquidity, whereas smaller bond issuers, let's say a corporate bond for a small company, that will carry a lot of liquidity premium because there are not a lot of investors that are trading in that bond, and that premium will basically compensate you for the relatively high cost you will bear when you are trying to close off that position in that bond. The last one is maturity premium, which basically compensates investors for the increased sensitivity of the market value of debt when interest rates start to change. So, as we all know, that longer term bonds have a much larger sensitivity to interest rates compared to shorter term bonds. For example, if we consider a scenario where the interest rate in an economy is currently 3%, now it suddenly rises up to 3.5%. So the loss of value in a longer term bond is going to be much more than in a short term bond. So loss of value, or let's say price of a bond, is going to be much more in a long term bond, long bond, greater than short term bond, because there's more uncertainty attached to this long term bond, and investors that have bought this longer term bond, let's say a 30-year bond, are stuck with that low interest rate compared to the interest rate that the economy is offering. So to compensate investors for that, we add a maturity premium in that required return so that investors are more willing to invest in that tool, because interest rates are inversely correlated with bond price. So if interest rates rise, bond prices fall, and the vice versa is also true. Okay, guys, so this wraps it up for time value of money. And just as a conclusion, we have now understood that money is not just about how much you have, but when you have it. So if there's one thing that time value of money teaches us, it's that $100 today is much more valuable than $100 in the future. Idle money is the worst choice if no investment opportunity is available. So it's much better to consume your money if there's no investment available than to sit idle on any cash. There's no such thing as risk free. Anything or anybody that tells you that this is completely risk free is possibly lying to you. So stay wise and make sure that your risk is compensated properly. Make sure that if you are taking on more risk, that is compensated by extra returns that you will earn on that investment. Otherwise, you are just taking on more risk inefficiently and you are basically positioned to lose your money. Thanks for watching. Hope you enjoyed the video and see you next time.